Irrational exuberance. Investor enthusiasm that drives asset prices higher than those assets' fundamentals justify. Unfounded market optimism that lacks a real foundation of fundamental valuation, but instead rests on psychological factors. The creation of inflated asset prices associated with bubbles, which ultimately popping can lead to market panic. To sum it all up, irrational exuberance is investors acting as if there is no uncertainty in the market, causing a positive feedback loop of ever higher prices. The problem with irrational exuberance is that it causes market melt-ups, which always lead to market meltdowns like we saw happen in the 1990s. In December of 1994, the S&P 500 was trading at $45.50. In August of 2000, that was up to $152.49, which represents more than 250% return. What followed was catastrophic when the stock market fell 50% over the next 2 years. Perhaps the most well-known example from the tech bubble, the company Cisco, ticker symbol CSCO, rallied 6,500%, and then it fell 82% in the market meltdown that ensued. Today, we have NVIDIA, which has rallied more than 400% in just a short 1 year and 3 months as the markets get into this AI craze. Things right now in our economy look about as good as they can get. We even had federal governor Christopher Waller come out in a speech recently and say real GDP is expected to have grown between 1% and 2% in the fourth quarter. We got this data, and it actually turned out our GDP grew by well over 3% in the fourth quarter. He continued to say unemployment is still below 4%. Core PCE inflation has been running close to 2% for the last 6 months. For a macroeconomist, this is almost as good as it gets. When things are almost as good as it gets, it's generally time to be more cautious as an investor. Even outside of our economy, investors are incredibly optimistic and bullish right now, which again is bearish from a contrarian point of view, where for every bear in the stock market, there are more than 3 bulls. Whenever we reach a level above 3, it's generally time to get cautious. We also have 53% of investors being bullish, while only 17% of investors are bearish. These are at historical highs and historical lows, as you can see represented on this chart. And I have to admit, things do look really good right now in the economy and for the stock market. In fact, if we go back to October of 2022, I was literally one of the only bulls in all of stock market media. That includes CNBC, and that includes everybody on social media. And as my Goldilocks scenario has played out, more and more people have jumped on this bullish bandwagon. I want to make clear, for 2024, I remain bullish. I'm more concerned of how quickly we might go up and how that might lead to a meltdown in the stock market. In today's video, that's exactly what I'm going to be talking about, but really quick before we get into it, if you guys are new here or returning and not yet subscribed, please subscribe down below and leave me a comment what you think the stock market is going to do this year in 2024. I love reading a bunch of different opinions because that allows me to come up with my own opinion and have a better basis and backing to whatever opinion I come up with. But you see, if we go back to October of 2022, we were all concerned about adverse macro conditions, such as seeing a recession, higher interest rates, persistent inflation, and the federal government deficit. Sitting here today, investors are much less worried about those things, and we're more excited about the likelihood of rate cuts this year as inflation continues to subside. And I've already made the comparison to Cisco. Today, we have NVIDIA, where investors are exuberant about the potential impacts of AI on the earnings of tech companies in particular. Now, will NVIDIA actually become the next Cisco, where it skyrockets and then crashes even despite AI making positive impacts to tech companies' earnings? It's possible, but I don't have the answer. However, I'm worried that the Fed has more power here in determining that fact than investors realize. Usually, to get the inflation rate to come down, you have to have some sort of slowing in our economy. And this cycle, for whatever the reason, there's many reasons for it, we have not seen an economic slowdown. Despite this, we've had Federal Reserve governors come out and say that they expect the Fed to lower interest rates before inflation even gets back to 2%. This is despite a very hot economy. Fed President James Bullard even came out and said that he thinks interest rate cuts could happen as soon as March, literally 2 months from today. I personally think that lowering the Fed funds rate while the economy is running hot could be a huge mistake. On October 27th, the S&P 500 hit its low, which is basically when the markets decided that the Fed was done raising rates. Very quickly, this has turned into talk about the Fed cutting rates, which has led to already a virtual melt-up in the stock market. Since the October 27th low, the S&P 500 has rallied 18.65%. Better yet, the NASDAQ has rallied by 23.28%. And this is over the course of basically 2.5, maybe 3 months. So we have to start thinking, if the simple belief that the Federal Reserve was done raising rates can have this big of an impact on the stock market, what impact would interest rate cuts have on the stock market? If the Fed cuts rates, they run the real risk of fueling an asset bubble, basically creating asset inflation, which creates a positive wealth effect, which gets people spending more money than they should, which can lead to renewed price inflation, which would cause a recession. Over the years, we have learned that recessions can be caused by the bursting of speculative bubbles. If Jerome Powell and his colleagues take a victory lap here and celebrate their success in bringing down price inflation without causing a recession because they lowered interest rates, they run the real risk of fueling this asset inflation that I've talked about. And when that bubble bursts, a recession most likely would ensue. Because when bubbles inflate to a certain point, it doesn't take much to pop them. This is why I'm concerned that the Fed's next big mistake will be inflating a speculative stock market bubble. However, Jerome Powell is smart and he has to realize this. And if he does realize this, he should reiterate that he is in no rush to lower interest rates. If he does this, all of my concern about this irrational exuberance goes out the window. If we look at the chart on the screen now, we can see that there are $6 trillion sitting in money market mutual funds. This is a risk-free investment where investors place their capital in one of these mutual funds and get paid a risk-free yield. The rise in popularity of these money market funds has been a direct result of interest rates going up, meaning people can earn more risk-free return on their money. If the Federal Reserve follows through and cuts rates, it's possible that a lot of this money sitting in money market mutual funds will come back to the stock and bond markets. You see, if interest rates come down, these investors in money market mutual funds subject themselves to interest rate risk. And if we look at the S&P 500's performance by sector, we see some deja vu from the 1990s. Tech companies, which are represented by the orange line and the blue line, are outperforming the rest of the stock market, and the other sectors are doing okay, but they are lagging tremendously. And this is where the potential for irrational exuberance exists. If interest rates are cut, it's likely that tech will continue to lead the way while the rest of the stock market lags. Again, this is reminiscent of the 1990s when the term irrational exuberance was actually founded. In my opinion, it would be very smart for the Fed to leave things where they are now, especially if the economy remains hot. I personally don't have a problem with a melt-up, but then the issue comes timing the top, because all melt-ups lead to meltdowns. And what's so bad with 4% bond yields after all? Usually when we have a time period where TINA exists, there is no alternative to the stock market, that's when we form these asset bubbles that eventually pop and cause huge crashes in the stock market and even some effects on our overall financial system. Now, I'm just a 22-year-old talking about the stock market on the internet. I fully trust that Jerome Powell sees these same risks that I see, and if he or other Federal Reserve governors get too theoretical with cutting interest rates, they should know that the stock market is going to get really excited about that. Arguably, it already has. This is why I believe right now we will avoid this 1990s irrational exuberance scenario. I believe that the 1920s is actually more possible and more likely, where we see significant technological advancements and a very, very healthy economy, which leads to the stock market performing very, very well throughout the decade. I fully expect Jerome Powell to push back against this narrative that's been created in the stock market. I don't believe we're going to see interest rates get cut in March. Jerome Powell is not dumb. He realizes that a positive wealth effect could bring back price inflation very, very quickly. But it's something that I'm going to be paying attention to because according to Trueflation, the inflation rate in the United States is down to 1.79%, and this Trueflation number has been a very good leading indicator for where the overall CPI and PPI rates are going to go in the United States. If the Fed does become concerned that inflation is falling below this 2% level, they could respond by aggressively cutting interest rates, as I've already talked about in this video. And this could come despite the economy continuing to perform very, very well. The result of that would be another melt-up in the stock market, with tech stocks leading the way, and the resulting valuation bubble would burst when the Fed would be forced to re-raise rates to counteract the asset inflation, which at the time would be leading to another round of price inflation. But again, if the Fed leaves rates where they're at for a while, which I think is the smart decision right now, I think that a 1920 scenario is actually the most likely outcome here. Now, the real problem for the stock market in 2024 is this, where large cap valuations are extremely elevated compared to the valuations of small cap and mid cap companies. Historically, small cap and mid cap companies actually trade at a premium to large caps, but right now, it couldn't be any more different from historical precedent, where large cap companies are trading close to a forward PE multiple of 20, and small cap and mid cap valuations are down around 15, maybe even closer to 14. This will not stay this way. Either large cap valuations are going to come down to meet small cap and mid cap valuations, or large cap valuations are going to remain flat, while small cap and mid cap valuations outperform and catch back up, or a combination of the two. Regardless, large cap companies are most likely to underperform this year and maybe even throughout 2025 as this valuation difference converges. This is why I've positioned my personal portfolio primarily into small cap and mid cap companies. Regardless of what happens, small cap and mid cap valuations are below historical standards by a wide margin, meaning that they will go up at some point in time. So as we move forward, we know that every extreme bull cycle eventually comes to an end. This one won't be any different. Right now, the risk is that we're going to see irrational exuberance, which could cause a melt up in the stock market, which would be followed by a meltdown. For long-term investors like myself, the meltdown would be very beneficial to us longer term, but it's likely that we, as well as other Americans, would be feeling a lot of pain if that were to happen. I currently remain bullish as I was back in October of 22 when nobody else was bullish, but I do think this first half of 2024 could be more the market's marking time while earnings catch up to these high multiples that these large companies have. But I think after valuations have normalized, we're in for a very exciting second half of 2024. However, I will say, if the markets continue to go up in a straight line for the first 6 months of 2024, that's when I actually do get concerned about this irrational exuberance leading to a melt-up, which would be followed by a meltdown. If you want to keep up with my thoughts on this channel, subscribe down below. You can also join my membership. It's how I avoid all these crappy sponsorships that these other YouTubers take. I'm completely self-funded, so if you want to help me out, please hit the join button down below, located right next to the subscribe button, or you can hit my Patreon link in the pinned comment. But with that, I hope you have a great rest of your day. Keep 10 toes to the ground and your chin up. Stay blessed. Peace out.